Good afternoon, ladies and gentlemen, and welcome to the SMARTSPACE Software PLC final results investor presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Please just simply type in your question and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company review all questions submitted today and publish responses where it's appropriate to do so. These will be available via your Investor Meet Company dashboard, and we'll notify you when they're available for your review. I'd also like to remind you that this presentation is being recorded. Before we begin, we would like to submit the following poll, and if you could give your attention, we'd be most grateful. And I'd now like to hand over to Bruce Morrison, CFO, and Frank Beechler, CEO from SMARTSPACE Software. Good afternoon to you both.
Good afternoon. Thanks very much, Mark. Good afternoon, everybody. I'm Frank Beechler, CEO of SMARTSPACE. I've been here previously as chairman, joined as stepped down to become CEO in 2018. Previous roles were CEO of One Click HR and non-exec chairman of Digital until 2019.
Good afternoon. My name is Bruce Morrison. I joined the company in November 2018. I was previously CFO of Bond International Software PLC, and prior to that, the finance director of Wembley Stadium Limited. I'm a qualified chartered accountant, having trained with KPMG.
So what we want to do, Guy is with us today as well, but he's sitting in the audience, but he would be available if there were specific questions you want to direct to him, and we can answer via Guy if required. What we're going to do now is take you through our results presentation for the year end to the 31st of January 2021. In addition, we'll also do a brief trading update on how we've got on in the first quarter of this year as well, which we'll cover off towards the end. We'll switch off our cameras now, and we'll just talk to the presentation as we move through. As you know, last year we went through we went through a major disposal of the business. We sold our enterprise division in August of last year to a US business called Four Winds, and we've reported on that previously. We have 3 operating companies in the group now, and as this slide shows, there are 3 distinct areas that we cover. Swiped On primarily focuses on visitor management, but we've now started to introduce desk management. In that business, we sell direct to customers. We have some partners, but they only account for about 0.1% of our overall sales. In that business, it's the typical value is about $1,200 ARR. It's about £600. Price points for Swiped On go from roughly about £30 a month to about £120 a month, depending on complexity and number of locations. We've got 35 staff in that business, main operating bases in New Zealand, and it's got Swiped On dedicated staff both in the UK and in Austin and Texas. Space Connect is our mid-market product, and for those of you who are familiar with our story, we acquired that business in the autumn of 19. We spent the last year integrating the business, and we've really got it in a position now where we're set to grow. It's a different route to market to Swiped On, and that it's focused exclusively on channel. We'll explain that a little bit more as we talk through the story, and sells at a much higher price point. ARR values typically of £8,000. It's got 16 staff. Its main operating base is Mildenhall in the UK. Prior to the acquisition, we actually had 4 offices in the UK. After the acquisition, we consolidated everything down to a building that we own in Mildenhall in Suffolk, which is where the base for A&K was originally. A&K is a traditional distribution business. In the past, it focused on AV products. What we have done over the last year is pivoted to focus on almost exclusively now in smart workplace solutions. Again, we'll explain some of these solutions in a little while. It's got 14 staff, and its main operating base is in Mildenhall, which is where the PLC is also located now. Its channel to market is basically 500 reseller partners around the UK. And again, we have special plans for some of those partners, which we'll explain as we progress. In terms of customers, we have lots of big names, not necessarily big value. Our sweet spot in terms of the market we're going after is companies and businesses with 1,500 or less employees per location. So part of the rationale for selling our old enterprise business is we are highly dependent on a small number of very large customers, which on the one hand could be quite lucrative, but then when you look at the nature of the deal you did, which is almost exclusively licensed in some cases, combined with an over-dependence on a small number of customers, then it's not really a robust model going forward for the size that we were. And with both SwipeDone and Space Connect now, what we want is a nice spread of customers across our revenue. So no customer is responsible for more than 3-4% of overall revenue. And everything we do now on software is purely SaaS. We don't offer any licensing deals whatsoever. SwipeDone has actually grown since we spoke to you last. We're now up to just under 7,000 locations and 4,800 customers. Still in 73 countries, but focusing on the 5 English-speaking markets, the US, UK, Australia, New Zealand, and Canada. That's where we spend most of our marketing dollars. Space Connect, when we spoke last, I think we probably had a half dozen partners, maybe a few more. We're now up to 22 partners. Our main focus for the past year has been the UK and Australia. We've since secured partners in the Far East, one of which has actually got offices in multiple locations out there. And we've got some partners in the Americas other than the US, which again, we'll discuss in a little while. As I said earlier, all of our business with Space Connect is done via this partner network, which we'll go through in a bit more detail in a while. In terms of the headlines for last year, I mean, COVID obviously had a big impact on our business. We actually grew through the whole pandemic and lockdown, but the growth did slow during those times because a lot of the business we sell to and we service were actually, they themselves were actually closed down. But since February in particular in the UK and in the US now, we've seen that those markets are unlocking again. In the meantime, of course, we've done some great business down in Australia, both in Space Connect and SwipeDone, and New Zealand and Canada. Those markets have actually grown. So there's a clear correlation between how badly a country was impacted and the impact on us. But we didn't have any market that suddenly dried up and stopped on us. I mean, the market's just slightly lower growth than normal. But what we have done in the meantime, obviously, is made sure we've still made money and built our ARR, and we've done that by increasing our ARPU. The other thing that's emerged in the last while is obviously the growth of this concept of hybrid working. There's no doubt now a lot of businesses are thinking of reducing their footprint. And the question that we get very often is, that mean if there's fewer space, if fewer buildings or less square footage, does that mean our market shrinks? In fact, it's the opposite. What you have is, if you took a typical business who had 500 staff, and let's say that they wanted to release one floor of the 4 floors that they had, they still had 500 staff. Now, if they all turn up on one day, they need somewhere to sit, and clearly they have more staff than they have desks. Now, you can manage that by a spreadsheet, but once you go into hundreds of staff, it becomes very, very difficult. And the user experience, i.e. the employee's experience, isn't very good at all. With one of our applications, SwipeDone or Space Connect, you can actually book your desk on an app. It'll make sure no one else sits at that desk. If you vacate the desk, you make it available to someone else. It can send a message to facilities to get the desk cleaned down, etc. Same holds with meeting rooms and collaboration spaces. So this shift to reduced footprint and hybrid is a real growth opportunity for us, and we're seeing it already in our pipelines and the sales that we're securing. We'll go on and talk about the individual businesses in a minute, but the main message from both really is both SwipeDone and Space Connect is making very good progress. Anders and Churn was impacted, but we think we've managed that well, and it actually it makes a contribution and was actually profitable in the first quarter of this year, which I know is the next trading period. In terms of SwipeDone, we've actually grown the ARPU in this business by 18% in the last year, and we've grown our ARR by 43%. Now, previously, when we purchased SwipeDone 2.5 years ago, the ARPU was about $52. When we spoke to you last year, it was about $78. We're now at $91. We'll tell you in a little while what's happened since the end of January. So basically, selling more to existing customers is a cornerstone of our strategy for growing the SwipeDone business. We did notice a slight increase in churn. Now, the churn in SwipeDone traditionally is always lower than a lot of our peers. We tick along normally at about 0.66%. It did rise to 1%, and it's plateaued at that level. It hasn't continued to rise. Now, a lot of that was down to businesses either temporarily or permanently closing during the pandemic. What we have noticed, though, is with our larger customers, they're far more sticky. So when you do see churn, it tends to be in the smaller value. If you were to compare revenue churn to customer churn, revenue churn is running at about 6% compared to the 11.8% or whatever on customer. So larger customers who generally are in other locations, multiple locations, tend to be stickier and less prone to churn in the event of a lockdown, etc. And even during lockdown, we added quite a few multi-location deals. There's 2 there that we've highlighted in Dennis Family Homes. We signed them last August. We're now in 58 locations. So that happened right in the middle of lockdown. And they're an Australian business actually, and they bought when they had I think their toughest lockdown I think took place in the state of Victoria back then. So it just shows really that certain businesses grew, and we were able to expand the accounts and grow the ARPU. We're not exposed overly to retail or hospitality, so as a result, then we were sort of immune to the major shocks that those businesses felt. But ultimately, what we're about is selling more to existing customers in that business, and we've invested in the platform quite extensively. We brought in a lot of COVID-related functionality last year, things like contactless check-in and visitor pre-screening, and customers really appreciated that, and it underpins one of our key strategies for increasing ARPU, which we'll discuss in a while. And then obviously we keep enhancing our multi-location capabilities. So for example, Chairman's Brands there now, they operate a whole range of restaurant franchises across Canada, but each of their operating businesses will have a different identity. What they don't want is walking into one of their offices and you just see the parent company branding. They want local company with local visitor policies and local agreements that people got to sign, and different workflows to drive visitor flows within the business. And that's what we've invested quite heavily in that. And I know we're going to come on later on to discuss making our product fully multi-language capable. And as we've been developing new features, we've actually been enhancing the multi-language, multicultural capability as well. We've expanded a revenue extensively in existing customers. We've seen growth from, most customers who have multi-location aspirations, people like Vestas and XPO here in the UK, DHL in the US, Access Information Systems, our largest account, added another 30 locations last year. At the last year as well, we were actually awarded the mid-market leader award by G2 Crowd for VMS, for mid-market VMS, which for us was a reinforcement of where we want to position ourselves in the market, as I say, in these businesses where we're aiming at 1,500 employees per location. In terms of where we grow the business for Swiped On, the major push was we implemented a price increase on the 1st of February. All new customers now are paying the new pricing. The interesting thing about that is if you look at the ARPU for the first 3 months of this year, it's running at for new customers, it's running about $140. So a significant increase on the $99 we were at, the $92 we were at the end of January. Next part of our strategy is to move customers through the various plans that we offer. In UK pounds, we typically charge £39 a month now for starter, and about £125 a month for enterprise or higher end plan. But we generate 50% of our revenue from 16% of our customers. Now, if we have low-end customers who might have simple visitor requirements, let's say you're a typical law firm and you've got 70 staff, the starter VMS product is probably good enough for your visitor requirements, £39 a month. On the other hand, if you want to do more complicated things and you want to integrate with Active Directory, for example, a whole host of other features, then you would need to come on to our enterprise plan, because that's the only place that those features are available. And what we're hoping then is that a business like that, where money isn't an issue, as against £39 a month to £100 a month, then people will tend to gravitate towards the enterprise plan if that's where the features reside that they're looking for. When we acquired SwipeDone in 2018, we're averaging about 1.1, 1.2 customers per location. By last year, we got it up to about 1.3, and then it moved on to 1.42 locations per customer. And it rose again in the first quarter of this year, where we, if you look from the 1st of February to the end of April, we averaged about 1.8 locations per customer, which is very encouraging, really, and it's a validation that this land and expand strategy that we're applying is working. The single biggest uptick we'll see this year is actually SwipeDone Desks. Now, SwipeDone Desks is basically the desk functionality from Space Connect rebranded and positioned at SwipeDone customers. We've just started in the UK, and we're going to focus on the UK to begin with, so we can perfect the sales process and then the subsequent implementation process. Desk is a slightly more complicated product to deploy because they have different rule settings. It takes us about an hour on our side to actually provision a customer. And at that point, the customer can go on and set things up themselves, or we can do it for them. Whereas SwipeDone Visitor, the customer does everything. On the other hand, the value of a SwipeDone Desk customer is significantly higher. We've used one example here, and say a customer would say 100 desks. Now, if they had simple visitor requirements, they would be paying about £39 a month. If they had 100 desks, we charge £4 per desk. So that would mean we take what was £39 a month ARPU and turn it into 439. So that's a significant uplift. Now, when you actually start to map that kind of number across our entire base, a small number of customers taking desks, it could have a huge impact on our business. And we just, for illustration purposes here, said, look, if we've got the 200 customers out of a base of just under 5,000, and they were typically that 100 desk size, the net impact of it could be to add £1 million for ARR, or just under 2 million New Zealand dollars. And the average ARPU across our customer base would, on its own, on the back of just those 200 customers, would actually lift us by another $33. So you could see now where as we drive the business forward, sell more to existing customers, and get them to take more modules. And we have other modules as well, such as deliveries, but in particular desks, and where we're seeing a lot of demand now on the back of return to the office strategies ongoing here in Australia and in the US. Then we've really got an opportunity to have a significant step change in the business, and we won't be increasing our costs to do that. We don't need marketing dollars to make it happen. They're existing customers. We can communicate by chat, by email, by phone. So you don't need to spend money on Google AdWords to get to them. And the cost of acquisition is negligible. So for us, really going forward now, those 4 strands of driving value from customers is where we're going to be working. Hopefully, when we get to the half year, we'll be able to report further progress in all of those. Space Connect then is, as I say, is a channel-only business. We did develop COVID-19 specific functionality to help companies make their environment safe. Things like being able to implement social distancing in the workplace and that kind of thing. We've categorized our partners into 4 levels. The top level is what we call a strategic partner. That's we've only got one of those, and it's Evoco, and that's where we basically create a white label version of Space Connect, and we branded Evoco NASO, which I'll explain a little bit more about in a second. The next level down then is what we class as either a distributor or a major reseller. Now, our biggest one of those so far is actually Softcat here in the UK. Now, Softcat have got about 15,000 customers who are handled by about 500 account managers. When they go into the marketplace now, as they're currently running a campaign that's aimed at their clients, helping them get back to the office after the pandemic. They'll talk to them about telephony and conferencing kit, but they'll also talk to them about tools that will actually help to implement COVID policies within the workplace and improve efficiency around desk utilization, room utilization, and reception. And we feature in that part of their proposition. We've grown that business extensively since last year, and go on and talk about one of their customers in just a second, just to give you a sense of the scale. But in an ideal world, we're looking for more people like Softcat, not just in the UK, but abroad. We've got a similar business in Asia, a company called ESCO. They're based in Singapore, but they've got offices dotted all over the Far East. We've recently got our first customer from them, and it actually came from their subsidiary in the Philippines. Now, that business, when it came in, had an ARR value of £18,000. The average ARR for Softcat customers is £8,000. Now, there's a few things to note about these ARR values. Firstly, that they're significantly higher than what we achieve in space in Swipe Down, but also normally customers will pay annually in advance. Now, we recognize it monthly as we go, as you'd expect on SaaS, and we would then we'd have the money sitting in accrued income in the balance sheet, but ultimately the cash is actually in our bank account. And whilst you look at the numbers, you see actually Space Connect was loss making last year. Our ability to flip it from not just loss making but cash generative, and probably become cash generative a lot sooner than profitability, is actually is quite a short jump, basically. Consistent 10 customers a month coming in at this kind of level turns that business in from sort of being cash negative to being cash flow positive. We're now up to 22 resellers. Our focus has been in the UK and Australia, but we're now starting to spread our wings wider. We did get active in the US last year, and we had some good conversations going with Crestron partners in the US, which is a fairly well-evolved network that we've exploited here, and we had in Australia. But we put those conversations on pause due to lockdown when it came in last March, but we will resurrect those in the near future. So we hope to make some good inroads in the US. Any numbers or forecasts you'll see from us in the market from our brokers, don't assume any sales from new partners. So we haven't gone and built a plan and said we're going to hit this plan if we sign up another 20 partners and each one gives us £500,000 worth of revenue. Our plans are very solidly based around customers that we had when the new financial year started on the 1st of February, and what we think realistically we're going to get from those partners and customers as we progress through the year. Clearly, our biggest partnership is Evoco. Now, in that case, just to remind you, what we've done is created a white label version of Space Connect, and it sells as a Evoco NASO, which is a brand new generation panel that Evoco actually are starting to market. We've been recognizing revenues on that product since January, which is really good. We've had 2 years of effort had gone into the software development side of things. So for us to see revenues coming through is really, really positive. We ourselves, through our A&K subsidiary, actually, we distribute Evoco in the UK, and the sales team there have actually booked their first 3 deals. Now, the interesting thing about those is that that we're getting them in the first instance, which validates what we're hearing from the rest of the Evoco channel. And the second thing is that we're able to bring in deals of a sensible value. Now, the average value of a NASO deal is about €7,000 ARR net to us. So that's after Evoco plus their distributors and partners have taken their margin. So €7,000 net to us. And the 3 deals that we've secured so far through A&K, they're of that size. So that's again a good validation that the basis for our planning actually seems to be correct. In addition to their partners, there's about 39 other partners like Evoco, like A&K around the globe, who will be selling Evoco NASO actively. And we've seen really good interest from them. Some markets are still quiet, like Germany, for example, but we've recently engaged with some major clients that their partners in Austria are working on. We've got a major pharma firm that's looking at us through their business in the Middle East. We've got despite the fact that Germany is closed, we're engaged with one of the big car companies there. Well, NASO are, simply because we've been on calls with the NASO team, providing technical input and that. So all the numbers and the indicators there are very positive. I know it's a long way from pipeline to turning into real cash and business, but we're heading in the right direction, and we believe that we've got sensible numbers out in the market. I believe that the brokers have built their plans around 6,000 NASO units this year, which isn't a huge amount when you consider the predecessor to the current products was selling sort of 60,000 a year. So we feel that we've got good headroom there, and we've got good traction so far. So we've now got 37 customers on Space Connect with an ARR of 400,000. That was at the end of January. Just to talk very briefly about how those partners actually go and drive business, because we're not about spending lots of marketing dollars to create leads that we in turn then go and bring back to our partners. We're more interested in supporting a partner with good content, good strategies for communication to their base, and then supporting them through webinars and demos and presentations. A good example of that is the screen on the right there, which is a campaign that's just been initiated by ProAV. Now, ProAV are one of our partners, and they've just released their return to the office offering, and this one is showcasing us. Now, ProAV have got 5,000 customers in the UK. Now, so you could imagine we don't need to get many of those to start to move the dial in our business. Softcat have got a similar RTO campaign, which started in April. They ran a webinar just last week on return to the office, and they had quite a few hundred customers on that webinar. And we're seeing very good traction from their account managers who are finding more and more interest from their customers. And each month we're seeing a progressive build of pipeline from all our partners, not just Softcat, but Softcat in particular, because they've got such a big base to sell into. One of the customers we signed with them last year was City Fibre, just to give you a flavour of size. We got that product deployed in 3 weeks. Now, that's one of our key differentiators to the competition. We would compete against businesses like Condeco and others where deployment times run into months, not weeks. Our fastest deployment ever of Space Connect is actually just a few days. We got the order on Thursday, set the customer up on Friday. They did most of the configuration themselves because they were happy to do that, and they went live on the Monday or the Tuesday. So really, what we're about is fast deployment and giving as much power for the customer to configure the product. Now, this City Fibre deal, that's an example of one of their screens on the left, and that's what you'd see as an employee if you want to book a desk. Now, in the case of City Fibre, they have a large number of fixed offices around the country, but then they also set up temporary offices where they're actually running a project. So they may be in Newcastle, for example, for the next 6 months, and they'll take out 10 desks in a WeWork there or a business centre. They want those desks included on their estate. In fact, I think that screenshot there is of somewhere like Nottingham or Hull or somewhere of where they've got a number of temporary desks. Those circles denote desks that they can't use because they're socially distanced. And when they actually book a desk, they do it all from the app when they vacate the desk. And it means one of their project managers won't just see the 10 desks in that business centre where he's standing. He'll also see all the other desks that are available around the country and can book them from his app. Now, that deal is much higher than the average we're achieving from Softcat. This one is coming in currently at about £27,000 ARR, and the likelihood is that will grow beyond that through expansion. So we're starting to see more and more higher value deals coming through as well, which for us is great, and without, as we had in our enterprise business, without an increase in our cost to actually get the customer live. A growth strategy on Space Connect is basically just more of the same. Now, we are looking for, our plans aren't predicated, if I can highlight that again, on finding lots of partners, extra partners this year, but that doesn't stop us going looking, and we're actively on that journey right now. We're looking for, utopia for me would be to find at least one other white label partner this year, not necessarily from hardware. It could come from property companies, it could come from FM businesses or others who want a solution like Space Connect put in their own branding to sell to their own customers. Clearly, finding more Softcat type deals both in the UK, in the Far East and Asia Pac, and over in the US is a key part of our strategy, as well as our channel sales down the line as well. We haven't put any number against how many we were looking for, but if we could double that channel in the next 6 to 12 months, I think we'll get great momentum going into next year. And as I say, just to reiterate, we haven't got a plan that's predicated on that. When you see the numbers that are there from Canaccord, they go out 3 years now, and that's very much around reasonable growth each year, as against huge expansive growth on stuff that's yet to come. Another development that you probably need to be aware of is that our plan ultimately is to consolidate all the software development down in New Zealand. So basically bringing Space Connect and SwipeOn together in one room. with the development be driven by a group CTOs, Matt Cooney, who was the CTO of Swipe Down, where we're actually making good progress on that. We've got I think 4 people in position now. We've got our eyes on another one. We need to get up to about 10 people for Space Connect software development in New Zealand. And if you've been to our listened into our earlier presentations, we really like working with the team in New Zealand. Really committed guys. What you have to pay in New Zealand for the equivalent in the UK is there's quite a significant differential, 10 to 20% depending on the role. And more importantly, we get really committed, driven, focused guys who just turn out really good product. And getting all of that under one roof, I think, will be great. There's no big economies to be had. It's a question that we get very often about, if you put 2 development teams together, can you reduce headcount significantly? We already run quite tightly anyway, and there might be 1 or 2 post savings. But to be honest, our view would be it's better to keep that in the business and use it to bring out more features that we can sell more. And sort of going into other countries is a major part of our strategy as we move through the year. Okay, nothing major to report in A&K. I've mentioned that pivot now to sort of becoming a specialist distributor of workplace technologies. The ideal type of relationship is highlighted by, for example, one customer that we've got from Softcat. They bought the software, which is Space Connect. They also need some panels to go on the wall. They didn't want to buy a Voco panels because they're too expensive, but they've opted for these IDEA panels, which are represented by A&K. So A&K basically provided the hardware, Space Connect provided the software to one partner who had one customer to deploy. We're looking for more and more of that type of business. We're also seeing increased interest in XY Sense, which is an Australian tool that we've worked on with one of our customers down in Australia. And we've now brought that product to Europe, and it helps companies to analyze their space and utilization and give real-time representation through ceiling-mounted sensors and that. So again, we believe we're the only distributor in the UK now that's focusing purely on the smart workplace technology space, moving it away from your traditional AV. The 500 partners that A&K has around the UK is really important to us. Not all of those represent an opportunity for Space Connect. We think about 200 could. We've signed up 12 so far, and we're actively now working with them to actually stimulate sell-through back into their base. And as we, I suppose, develop our processes there, we look to expand that as we move through the year. We've seen a big increase in intake in the A&K business as we came out of the various lockdowns. It was frustrating last year because we had a quiet first quarter, even though the sales momentum maintained. Came out of lockdown, then things slowed down over the summer, got it back rolling, and then we were back into lockdown again. But we've been able to manage the costs there, so whilst lost some money, it wasn't hugely harmful. But when you see the financials in a second, you see there was quite a big drop in hardware. But bear in mind that the margin on that hardware is actually a lot less than losing software revenue. I'll hand over to Bruce now.
Thanks very much, Frank. So we'll start running through the financial information. The key to FY21 is really the growth in recurring revenues, which were up 64% year on year, and SaaS up 71% year on year, driven primarily by growth in Swipe Down, which itself was up by 59%. Space Connect, we came in from a very low opening position. We did grow it, but it is not sort of a meaningful number for this year. Revenues were adversely impacted by the pandemic and the impact that had on the low margin hardware revenues, which themselves were down by 38%. But as I say, the key to this business is growing recurring revenues and particularly growing SaaS. At the end of the year, our annualized run rate, our ARR, was up 50% year on year. And we go into this year with 3 million of ARR at the start of the financial year. And Frank will go on to talk a bit more about where we stand really towards the end of the first quarter. Our gross margin is improving as SaaS revenues form a greater percentage of our overall revenues. And as we move forward, we see that improving as in future years as well. We stand at 57% for FY21 compared with 41% in the previous financial year. Clearly, SaaS revenues are much more profitable at the gross profit line, 91% compared with the lower margin hardware. Our operating costs are up 28%. Most of that increase is the fact that we had Space Connect for the first full year, whereas the previous financial year we only had Space Connect for the last quarter. We've also, as SwipeOn's expanded, the operating costs over there have increased. Our costs were second half weighted. When the first lockdown hit back in the early part of the last financial year, our immediate decision-making process was to put a hold on marketing, to delay recruitment, and to reduce our costs as far as possible whilst we assessed what the impact of the pandemic was going to be on the business. It became clear after a couple of months of sort of slow growth within SwipeOn, growth resumed normal levels from sort of June, July, August. And so we resumed our expenditure within SwipeOn and resumed our plans for recruitment. So we do have an element of increase built into the second half. During the period, we continued we sought to minimize the impact of the pandemic on the results of Anders and Churn through furloughing staff and closing the offices, I think, which Frank has referred to, both in the first lockdown and from November through till really March and the second lockdown in the UK. In terms of our cash flow, the net cash inflow for the year was 1.92 million, with an outflow in the first half and then an inflow in the second half, bolstered by the disposal proceeds from the sale of the enterprise division. I guess a couple of things to note here. We had capital expenditure on software development of just under 700,000 in the year. At least around 2/3 of that related to the enterprise business, which we subsequently sold. So our development costs, capitalized development costs going forward will be lower than they have been in previous years. Total development costs are around about 1.3 million, and we last year we capitalized around just under 300,000. That predominantly relates to the work we did on completing the development of the Evoco NASO panel. Software for the Evoco NASO panel. At the end of the year, we had 4.5 million, and we have a small mortgage on the premises we own here in Mildenhall of 400,000. But we feel we're well placed. We have sufficient cash to move forward with our development plans. And as we're going to talk about in a minute, 2 out of the 3 businesses are cash positive at the moment. With Space Connect, as business grows there, we'll look to make that cash positive as soon as we can. So overall, the group, our intention is the group to be cash positive, certainly by the end of the current financial year. Thank you. Over to you, Frank.
Right. In terms of market, the total addressable market that we're working at is significant, as you imagine. That hasn't changed in the last year. If anything, we'd argue it's got bigger. There hasn't been any significant developments on competition. We've seen a lot of entry-level visitor systems come in to act as an equivalent, a paid-for equivalent to the NHS app that you see in this country. But if you look at the G2 crowd quadrant that they've created for the visitor management market, there's about 7 or 8 products, people like Envoy and ProxyClick and ourselves in the top right-hand corner, and we're very much in that space. And we're after people who want to do more involved things around visitor management, as against just checking a customer in due to COVID rules in that locality or whatever. Same on Space Connect. Again, no major developments there. I know that I've seen some of the questions that are coming up on the screen there now, but one of them relates to if, say, someone like City Fibre, how many systems did they look at before they made the decision to buy Space Connect, was one of the questions that's actually on the screen there. And so in their case, they actually looked at 3. They looked at Condeco, Space Connect, and another product called Flowscape. We don't come up against Flowscape very often. Condeco is quite a big player in the UK. We come up with them quite a lot. Our win rate against them, though, is very high now, and it's accelerating. And we differentiate ourselves at 3 levels. Value, i.e. we tend to be cheaper per room and per desk, but we actually offer more for the money. The second thing is speed of deployment. We can get it in weeks, days or weeks rather than months. And thirdly, then, is the amount of configuration capability we give our customers. We're trying to bring the ease of use of configuration back into Swiped On. But again, there isn't a dominant player in the market. I don't think we've had a case where we've actually displaced anyone when it comes to things like desk management. So we're not working in a mature market like a finance software or CRM, where you're constantly trying to out-feature the next, the current offering that a customer is using. Virtually all the customers we're going to have nothing in place. If they have something, it's going to be using Outlook or using a spreadsheet. So we are, I don't like the term, but we are in sort of relatively virgin territory, where there's a you know, and it's a market that has gone from a nice to have to a must have, to people saying, actually, there's a lot of merit in this, because after staff, premises are our next largest fixed cost in the business. And with somewhere like London, a typical desk costs £28,000 a year to run. You know, you reduce 100 desks from your business, that's a big saving. Now, you can only do that if you've got the tools to optimize it. The last thing you want is your top 10 guys turning up and only find there's 5 desks, and they spend the morning sitting in Starbucks or something because there's nowhere in the office. And more importantly, then, once you later on, when you're looking at moving your offices and changing and say, will we get rid of that meter and put some more desks in? If we can give you some good analytical data to support your decisions, then it just reinforces again the need for that. And then you layer in all of the regulatory requirements and the safety requirements around the back of COVID, and you can see where the compulsion for the product comes from. So it's no more competitive than it was a while ago. A lot more players in the field, but not at the level that we operate at, in Visitor in particular. There's been an awful lot of M&A activity. Honeywell and Schneider Electric have both bought in the space in the last while. Honeywell took out one of our biggest competitors in Australia called Sign in December, and Schneider invested in Planon in November, who are a Dutch business. We did have we don't have a strategy now that's predicated on buying any businesses. We've made our acquisitions and they've given us all the tech we need. We don't stop looking, and when opportunities emerge, we're, as you'd expect us as management in the business, to investigate them to see if there's something there. We did have a look at Who's on Location, for example, and ran the slide rule over that. But just to give you a sense of the kind of values that these businesses are attracting, that business was turning over about $3 million, losing $1.5 million, and they were looking for $42 million for the business. Now, conservatively, we would value, on a like-for-like basis, the Swiped On business is an infinitely higher quality business than Who's on Location. It's got more customers, got higher ARR growth, it's got higher ARPU, everything. It's better in every respect. And we conservatively value that business at £35 million, say, right now. So we believe we're harboring some very big value within our business. We really don't believe going forward that if we ever get acquired, we should be acquired at the current level. We feel that there's an awful lot more headroom in this business. We have an aspiration of taking this business to at least £5 a share. Now, if you look at, say, some of the numbers that are out there from Canaccord, and you look at the exit ARR in 2 years' time, and you multiply that by 10, you get a valuation that brings you back to that sort of £5 a share. So lots of M&A activity. By its nature, then, it means that as time goes on, there'll be less to buy. And if there's less to buy, generally the values will go up. And we want to be in a very strong position. But to me, building our value in our business compared to our competition is around strong ARR growth, strong ARPU growth, strong customer location growth around the globe. But then there's two sort of, I suppose, non-cash areas of growth that I think we can create value. One is a really well-evolved development team in New Zealand, which is seen as a very safe part of the world, considering what we've just been through. And the second thing then is something we'll talk about in a minute, which is to really start to penetrate non-English speaking markets more so than we've done to date. In terms of current trading, so current trading from us is from the beginning of the 1st of February right through to the end of April. So that's our financial year begins on the 1st of February. And so really for the first quarter, we've implemented that price increase for new customers. And as I mentioned earlier, the ARPU for those customers has gone to 140. Now, there's obviously potential there to do more within the existing base over time as well. So we expect to see that momentum continue as the year progresses. Since the 1st of February, our ARPU has grown again. It's up another 8.1%. So we're now at $99. And that's the average across the entire base. And it obviously includes the new customers added since the beginning of February. And as a result, our ARR growth has grown further again by 9%. Our strategy is still very much about going after higher value customers in that mid-market with the cross-sell. You've seen the evidence that we've put out today of the kind of deals that we're doing. We've added 318 locations in the first quarter, and the interesting stat there is that we've averaged about 1.8 locations per customer, and you expect to see more of that as we progress. And whilst on paper you look at our customers, I could have a single site law firm in Sydney who's only got 35 staff. That to us is a customer. But Access Information Systems in the US, who's currently now running about 170 locations and worth infinitely more money to us, also counts as a customer. So I suppose to look at location growth as a key marker of how we're progressing as against just customers. Clearly in Swiped On, then one of the big areas of focus around development is to get the product multi-language and multicultural ready. You might remember a couple of years ago we went into the Dutch market just to see what it's like going after a market where English wasn't the first language. Even though we're in 73 countries, ultimately the customer will only see the front. It's only the visitor sees the front end, which is in local language. But the product was never geared up originally to be fully multi-language at the back end. And when we researched what came out of the Dutch experience, there was two things they were looking for. And coming from such an Anglophile country as Holland, we had to sort of sit up and take notice of it. Firstly, is they expect the whole product, not just the front end, to be in local language, but they also expect the support and pre-sales to be in local language. Now, our ambition this year is to get into at least one non-English speaking market. Now, the gateway to getting to that is we got to do some big development work behind the scenes on the overall platform. At this stage, it's probably about 2 months of work. Now, we've had a really busy roadmap over the last while, so we have put it on the board for the second half of this year. Once we've done that work to the platform, the actual act and cost of taking our product and putting 10 languages in is actually very cheap and very fast. Because once the entire system is sort of configurable, we can just load in language sets. We buy language sets for a product for, I don't know, hundreds or thousands of dollars, in tens of thousands. And the act of compiling it literally takes 20 minutes or an hour or whatever. It's not a big development job, but it's only possible when we actually get that, when we get the underlying platform fully configurable and ready for multi-language, multi-currency. And we are actually, the plan now is to switch the dev team onto that, and over the next few months to get that ready. It's in all likelihood, when we do go after a non-English market, we're probably going to go after somewhere in the Far East, whether it's a Japan or whether it's South Korea or Indonesia, that we'll tell you in due course. And the idea being then is that we will support it out of New Zealand. So let's say we did decide to have a go at the Korean market, where all of our engagement with customers done through internet, done through chat. So we don't deal on the phone or whatever with people. So we'd have someone who's probably someone who's from Korea, who's moved to New Zealand, who's work on the team there. They would deal with the pre-sales inquiries. The entire product would be in Korean. And what we want to do then is stick our toe in the water and probably spend about £150,000 for an initial campaign that would last about 3 months. If our experience in Holland is correct, the cost of Google AdWords in the markets we work in is much, much cheaper once you come away from the main English-speaking markets. You can pay $20 a click on AdWords now for words like Visitor Management System. When we went to Holland, the Dutch version of Visitor Management System was something like 20 cents or 10 cents. It was really tiny. And we expect the same when you look at the competitive situation in those markets. So the idea would be, if we find good success and we feel that our formula works, we'll want to scale it really quickly. If it's not working and doesn't meet our criteria, we'll withdraw. But if we've only spent £150,000, then it won't have broken the business or used up all our cash. ultimately, though, if we can pull it off, I see that as a huge value driver in our business. The fact that we could be very active in a lot of non-English speaking markets, and in many of our US competitors, they talk about it international, and they will be in geographies like Australia and the UK. They generally don't go deep in individual countries, and I believe that could be a really big value driver for our business if we get it right. Space Connect, then, in terms of where we sit today, a rapid acceleration in the sales pipeline. It's gone from 500,000 to 1.1 million in the first 3 months. Obviously, the announcement in February of that roadmap coming out of lockdown, that was a major catalyst. Even then, that week, we had 3 or 4 or even more deals that actually emerged that had been sort of stuck in the system since the previous December, just before the lockdown was announced. So we now, as everything seems to be unlocking, we're seeing more and more interest. Now, I know it's a long way from pipeline to turning it into sales to turning it into cash, but all the indicators there are actually all very, very positive, and we're very happy with progress. And obviously, then seeing the NASO deals coming through is very encouraging as well. A&K has done well in the first quarter. It actually made us some money, and we've seen our first NASO sales coming through. And as of last Friday, we had £4 million in the bank. So and if you look at our forecast, the analysts have seen us come out of this year with the same cash that we went into this year. So they're forecasting more or less cash break even this year. So we're not burning through cash at the kind of rates that we were when we had the enterprise business originally. So in conclusion, I think, we're in a very exciting market. There's no dominant player. We don't have to displace existing systems, and our cost of acquisition is relatively low. And we believe we've actually got an effective sales channel for both our main software product offerings. There's an awful lot to go for, and we're not talking here just about the UK. We've seen great growth in the US, and we see that continuing. And all the markets that we operate in, there isn't, again, they all display the same characteristics of no dominant player and actually high growth and good interest. So we believe we could be at this for quite a few years to get to a point where we become a sizable operation. And it clearly underpins our ambitions to get this business to a valuation of a sort of 140 million and above. And that we don't see that as an end point. We see that as a nice staging post. And from my perspective, trying to motivate staff, if you set an unrealistic target about where we could take the share price to, they'd say, well, why do I even bother? Because it's actually too unachievable. But we think a £5 share price from where we sit today is actually perfectly achievable, and is still very much in our sights. And we've got the cash to execute our plans, and we haven't got a business that's predicated, and we now need to make another 5 acquisitions to make a success. I think driving good organic growth from our business will be important. We'll never stop looking at acquisition opportunities, but we look for ones where they're accretive, where they can bring a decent SaaS revenue role, and where we can probably sell our software into an existing base. But right now, our focus is really on very strong organic growth and driving through to cash generation, profitability, and then all of the metrics that define us as a high quality SaaS business: high ARR growth, high ARPU growth, and a great addressable market with low penetration and low churn. And we're doing it all in a market that, as I say, I hate the term, but it is relatively virgin territory, which is a good place to be. And that's us. And I think what we'll do is hand over for some questions now.
That's brilliant. Thank you very much indeed, both to Frank and to Bruce. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But just while the company take a few moments to review investor questions submitted already, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your Investor Meet Company dashboard. I'd also like to remind you that feedback is important to the company, and immediately after this presentation has ended, you will be redirected for the opportunity to provide feedback in order that the company can better understand your views and expectations. Frank, Bruce, I don't know if you just want to bring your cameras back on for the Q&A, and what I'll do is I'll take away the slides just to make sure that that's in place. There we go. If you need the slides, guys, just let me know and I'll bring them up immediately for you. As you know, investors had the ability to pre-submit questions, and we've got a couple that I'd like to start off the Q&A with before looking at those that have come in. The first question that we received reads: how do you feel the different strands of the company are positioned for business now that most countries are emerging out of the pandemic?
We've probably covered this at various points in the presentation, but I think the 3 businesses are really nicely positioned. I mean, we've been realistic about A&K. I mean, it is a lower margin business, albeit at 30%. And we haven't gone and built a plan that means that that's going to double or treble in size in the next few years. On the other hand, we really have a nice scalable operation in Swipe Down that's proven. And it's really a question of doing more of the same. We brought Nicole Brookie in last year to drive sales, and she's been really evolving the sales structure. And for us to grow that business now, it's about incremental heads, but only when we see the business coming through. And with the multi-language capability, it takes us into new markets. So I think that's really well set up. And obviously big opportunities for Space Connect. I mean, we're now just starting to see proper momentum in that business, and we see that accelerating. So I think all around we're in a good place.
Perfect, thank you. You've previously stated it took about a week to produce a Dutch language version. Is this a fixed overhead per language? And is it the case of producing a set of language-specific data entries only, i.e. the coding and design framework is already in place to support any language?
Yeah, I think when we did the Dutch version, what took us a week was to create the front end of the product. And what we've got to do now is work on the back end, which ultimately is, I suppose, configuring the overall platform for full multi-language capability rather than just a bit that the visitor sees. Now, that work, as I said earlier, we're just about to embark on it, and it'll probably take us a few months. Once it's done, the cost and time to actually drop in other languages is very small. I mean, language sets we basically export a file, we send a translation agency, that takes a day or two, then it's validated by a human along the way, and then comes back to us. But we're into hundreds or thousands of dollars per language as against tens of thousands of dollars. And then compiling it back into the product is actually very simple and straightforward. So we're not looking at big investment in either time or money to actually create non-English versions.
That's brilliant. Thank you very much indeed. Obviously, if I could ask Bruce maybe to open up the Q&A tab on the right-hand side, and if I could hand back to you perhaps to read out the questions, and where appropriate to do so, just give a response, and then I'll pick up from you at the end, if that's okay.
Sure. Thanks very much. You mentioned multi-language capability. Which territories will you initially be targeting, and is this through existing reseller relationships or organic?
Our main push in multi-language is going to be through Swipe Down, and that's direct to end user. And we're looking at markets predominantly in the Far East, because we feel there's a good demand there, and the competitive landscape there actually it would make it easier for us to go in there. Eventually, we'll come back and maybe target European countries, but they're not on the initial target list. We've obviously got customers in a lot of the European countries right now using the existing product, but we feel that we could probably make more headway in the Far East sooner. And it would be a market that's where we don't see as many competitors.
Okay. With the partner network targeting growth, why are they selecting you over the competition, and are you displacing an incumbent?
Some cases they might carry multiple versions of desk management and meeting room management. So, and where we don't enforce exclusivity on any of our partners, and we're happy to be measured against any competition that are put up to a customer. And we focus on 3 areas of differentiation. The first one is value for money. The second one is speed of deployment, and the third one then is ease of configuration and making sure we put as much into the hands of the customer as possible. And we seem to win really well on all 3 of those where we win. And when I look at deals that we've done through partners now, where they've offered different options, our win rate is higher than I would have expected, to be honest. So I think we seem to have sort of found our sweet spot.
Okay, I think I'll probably take the next one. Hypothetically, if Evoco NASO sales hit 10,000 units sustainably, what is the annual cash flow net to SmartSpace? Now, we have included a slide in here which gives some detail in the back of the presentation, although we didn't cover it in the main presentation, that gives some information on how NASO works. I mean, at a very basic level, the panels, we receive a one-off fee per panel sold of €70. We also, for those panels to work, and once they're fitted on walls, there is a hosting arrangement that a customer will pay €36 per annum for. So basically for 10,000 panels, that gives an income of around about 1.1 million euros a year. There are software modules for meeting rooms, enhanced meeting room functionality, and for desks and for visitor. I mean, clearly the amount we will generate depends on the take up of those additional modules. Looking at 10,000 panels, that probably equates on an average to about 700 customers. So if you took each customer an average of 300 desks, that would, and assumed a take up of 10%, for example, that would give us 460, a further €500,000. If that take up was 20%, it would give us another €1 million on top of that. So, it could be anywhere really ranging from €1 million, €2 million to €3 million. There is a mix. The mix of the software may be different. And clearly, I think the take up is likely to be higher for meeting rooms than desks. But at the moment, we have some data go on, but very little at this stage. But hopefully that gives you a flavour for what an average customer could generate around about €7,000 of ARR and a one-off license fee for us as well of about 1,500 euros. That's the plan.
Okay. The next question up there is how many alternative products would a City Fibre look at before taking SmartSpace from Softcat? They looked at the 3 products in total: ourselves, Condeco, and Flowscape. And again, the final decision came down to the fact that one, we were prepared to give them a trial and get them switched on and let them have a play, and then coming back to those 3 differentiators of price, speed of deployment, and ease of configuration.
What should the sustainable gross margin of the group as the business achieves scale? We're targeting a gross margin of around about 70% in the current financial year, rising to 80% over the next 2 years. I think a gross margin of 80% is definitely what we should be targeting and what should be achievable.
On the last call, we heard about early from Dave K. We heard about early steps being taken in the US market. Can you give us an update on how this is progressing? I think we touched on it in the presentation, but we've made good progress last year. The way we want to get into the US is to go through existing channels, and we're targeting the Crestron channel last year, and with some very good conversations, which they all came to a grinding halt back in March. We did nothing on the US for the remainder of the year, mainly because we weren't going to be able to travel and we couldn't engage. However, we are starting to open up again now, and Matt Pope, who runs the Space Connect business, and Patrick Graff, who's just joined us to drive new partner acquisition, and myself, we're now putting our attention into what we can do to get things rolling in the States. So hopefully, by the time we report in the autumn on the half year, we'll be able to indicate that one, we're engaged, and 2, we're starting to make progress. I mean, the potential there is huge if we get it right. We've seen that firsthand from the Swipe Down business. Also, Evoco Naso is getting really good traction in the US as well. So all the indicators are it's a good time to go back to the US now. And again, to reiterate, we haven't got a plan that's predicated on the US suddenly coming alive and generating 50% of our sales, because when we developed the plan in the last quarter of last year, we were working on the basis that it was going to stay shut for the foreseeable future.
The next question, is Crestron in USA a threat or an opportunity for us?
No, very much an opportunity. Crestron they're hardware manufacturers, and with a bit of software like Space Connect, it takes their quite expensive room panel and makes it do very interesting things. They have a rudimentary room booking system themselves, but ultimately they look to technology partners to actually produce to generate the value for their customers. And so we see it as a big opportunity. There's about 400 platinum partners in Crestron. Now, not all of those focus exclusively on workplace, but a high proportion do, and they'd be our target market. And where they would not just go and supply hardware, they would undertake the design and the subsequent implementation and that as well. So, and we wouldn't see ourselves sticking just to Crestron when it comes to the US. It's just a very good jumping off point in terms of defining a market and going after it very cleanly without having to spend months investigating and going through discovery and then create the messaging and stimulate the interest. So, so a big opportunity, I think, really for us in Crestron.
What percentage of the pipeline would we normally expect to convert?
It depends on the channel. I mean, if you look at Swiped On, we the typical model is to get a number of customers every month using the product on a trial basis, and that can range from 300 to 500 or 600 in a month. And then our aim is to convert between 20 and 30% of those to paying customers, and that's been consistent through the whole life of that business. When it comes to indirect channel, then it very much depends on the individual partner. Softcat, we've got a very good win rate at the moment. I think we're probably up at 7 or 8 out of 10. It's higher in ESCO, but then we've only done one deal with them. So I'd expect that with the kind of channel we work with, by the time the deal comes to us and it gets onto our pipeline, it's very well qualified. So I'd expect the win rate to be high. Yeah, so I think it's good, really. But at the heart of that is having a good product at a sensible price that people like. So,
Bruce, Frank, I'm just obviously a little bit mindful of time. We've just gone through the hour, and I know for every question you answer, there seems to be more coming through. So I don't know if there's anything further that is there that you feel that might be addressable now. If not, of course, we'll provide all the questions that you haven't got round to in case there's the opportunity to provide a response afterwards. If not, Frank, perhaps I could just hand back to you for a few closing comments, and then I will redirect investors to provide you feedback.
Right. Well, I suppose really just to say thank you very much for your time today. We've got a great business, an exciting market, despite the bigger challenges that we're dealing with in the world. And I think we're ideally placed to capitalize on the opportunity. And we've got some great products, and we've got a much cleaner, tighter business that's well funded now compared to where we were a year ago. So, and thank you very much for existing shareholders for your support.
Bruce, Frank, thank you once again very much indeed for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide feedback in order that management can better understand your views and expectations. This will only take a few moments to complete, and I'm sure is greatly valued by the company. On behalf of the management team of SmartSpace Software, I'd like to thank you very much for attending today's presentation. That now concludes today's session. Good afternoon to you all.